James Knightley is Chief International Economist at ING. He's joining us now to take some questions. James, good to have you with us here. Thanks very much. So this rate cut business is perhaps getting the start date for that is will get pushed out a little bit. What's your sense? I mean, do you think, post CPI reactions in markets usually fades a day or two, and then, that's what we've seen over the last 5-6 months now. Substantial reaction on day one, but then it doesn't last. Do you think we'll see something similar here, or this is a bit of a important shift now?
Yeah, I think this is a little bit more this time around. We've got to look at the US economy and see what it's doing. I mean, it's added more than 800,000 jobs in the first 3 months of the year, and inflation has come in at 0.4% month on month on the core rates in each of those 3 months. And the economy itself is on course to probably grow about 2.5% at annualized rates. All those three things are too hot for the Fed to contemplate imminent policy easing. So as a result, these sort of mild hopes of a June rate cut have really been crushed. And we're now looking at really September as the earliest chance of the Fed easing. And even then, it's not guaranteed. We do need to start seeing some consistently lower inflation prints. We need to see 0.2s. Not 0.4s. And we also probably need to see the jobs numbers coming close to 100,000 or below, rather than 300,000 as what we got last Friday. So we do still need to see some quite big shifts for the market to become really confident that there is a case for rate cuts in the United States.
Okay, fair enough. James, hi, good morning. So you're saying September is the earliest chance that the Fed could go ahead and cut rates. Got that. How are you feeling about a market like India now? Because there are so many things that are working in favor of India, and India is topping the charts in terms of being the most favorable investment destination for a lot of global market observers. Would you concur with that view even now? And is that the base case for the rest of the calendar year?
Well, I think, what we're seeing globally is a more positive backdrop. We're starting to see some better numbers out of China. India's still doing very well as well, of course. And even in Europe, we're starting to see a few better numbers as well. So that is providing a decent backdrop for optimism as we currently stand. And we're seeing those interest rate cuts being scaled back, and market optimism still there. But nonetheless, the higher that rates stay for longer in the US or Europe or wherever else, the greater the chance that we do see a recessionary forces building. Because we've got to remember in the United States that, yes, things are going pretty well right now, but we are seeing quite a rapid rise in delinquencies on credit cards, on car loans. Commercial real estate is also a big risk for the United States. And as I mentioned, the higher that rates stay for longer, the greater the pressures that is put on these sectors, which are already starting to feel some pain. So my concern would be that, yes, the next few months will probably be fine, but there is growing evidence to suggest there is distress out there. And also importantly, in the United States, lead indicators for the labour market are all universally turning softer. The ISM Institute, for example, has reported 6 consecutive months of contraction for the employment components in the United States. The National Federation for Independent Business, the small business sector, is reporting the weakest hiring intentions for basically 10 years. So these sorts of narratives do suggest that we should be a little bit wary as we progress through after the summer in the United States. I think there could be a shifting dynamic that still we have to acknowledge and could yet lead to the Fed having to respond perhaps a little bit more aggressively than is currently priced.
All right. Hi, James. Good morning. Nigel on this side, and good to see you, Vin. James, I wanted to ask you a view on China. There is some hope that maybe, in fact, it's going to bounce back after the kind of disappointing data that we're seeing, disappointing economic data that we've been getting for the last 12 to around 18 months odd. Are you seeing signs of that? Or do you think the Chinese economy on the whole will continue to, see some pressure? And this bounce that we're seeing in commodities and the equity markets, that's really not really called for. Your take?
Yeah, I think there has been a little bit more optimism coming through in China. The purchasing managers' indicators, these barometers of business activity, have shown some really good momentum over the last couple of months. And that's come in the absence of any meaningful government stimulus that a lot of people have been calling for in China. So there is a little bit of hope that we might start to see China contributing a little bit more to the global economy, and that would obviously be a good news story. But as you mentioned, commodities. Yeah, I mean, there is this bit better tone to global activity, and that I think has been contributing. But also, I think there is concern about geopolitical risk, and also the US election as well. What does that all mean for commodity prices and tariffs and trade war potentially if we do see Donald Trump re-elected there? So at the moment, this sort of cautious attitude, I think, is sort of adding, the geopolitical uncertainty. We've got a bit of strong growth. We're just not sure how the US politics is really going to unfold. We are seeing people park a little bit more money in commodities for now. And again, it's fine for now, but as I mentioned, we've got risks still emerging. This financial stress is something I'm just keeping a little bit of an eye on. And as I mentioned, the higher interest rates stay for longer, the greater the chance that those stresses build and do unravel and do have a negative impact, both on the US economy, but also global markets as well.
I mean, I think, James, you'd agree, Trump or Biden, one thing I think we can agree at least is that all politicians want markets to stay up, right? That's the one sort of inevitable truth over the last couple of years. It doesn't matter whether you bleed whatever, red or blue, you want the market up. You want the S&P at whatever it is. Well, James, thanks very much. Great to have you with us here on the program, and hope to see more of you here on CNBC-TV18. Sonia.
All right. James, thanks a lot. And, of course, we'll get back to chatting about all the moves in the market. But more importantly, if I can just squeeze in one last question, James, before we let you go. I mean, it just came as an afterthought. But since you briefly mentioned commodities, right? Have you been able to decipher this massive move in gold? And as an economist who's perhaps been tracking this move for so long, what is your view now?
Well, I mean, it is one of the great inflation hedges as well, isn't it? And I think, we've seen such consistently strong inflation numbers out of the US. I guess there is always that desire to park and try and maintain a bit of stability. But I would counter that to some extent that actually Chinese inflation, for example, this week, much more subdued. European inflation is looking much better behaved as well. And I think in time, the US inflation numbers will start to look better. And that may also help take some of the steam out behind the gold price.
All right, we leave it at that, James. Thanks a lot for joining and appreciate your thoughts here on CNBC TV18. Let's